A leaked sex tape didn't end Kim Kardashian's career. It funded a $4 billion empire. Welcome to the Founder Files, Beyond the Brand. Most people think the Kardashians got lucky. A scandalous video, a reality show, and suddenly billions in the bank. But luck doesn't build a private equity firm. Luck doesn't get a shapewear brand from zero to a $4 billion valuation in 4 years. And luck definitely doesn't survive Forbes publicly calling your family out for allegedly faking financial documents. This is the story of how the most mocked family in America became one of the most effective brand-building machines in modern business history. To understand the Kardashian empire, you have to start not with Kim and not with the tape. You have to start with Kris. Kris Jenner grew up watching Hollywood from the outside. She was married to Robert Kardashian, the attorney who became nationally famous during the O.J. Simpson trial. The family had visibility, but visibility alone doesn't pay. After the marriage ended, Kris remarried Olympic gold medalist Bruce Jenner, later Caitlyn Jenner, and watched the entertainment landscape shift under her feet. Then she saw something on television that changed everything. The Osbournes, the MTV reality show following Ozzy Osbourne and his family, premiered in 2002 and became a cultural phenomenon overnight. Kris reportedly watched it and immediately understood the formula. Fame plus access plus a camera equals money. So she picked up the phone and cold called Ryan Seacrest's production company to pitch a show about her own family. That single phone call became the financial foundation of a multi-billion-dollar enterprise. Keeping Up with the Kardashians premiered on E! in 2007. The timing was not accidental. That same year, a private tape recorded by Kim Kardashian and Ray J in 2003 was leaked publicly. For most people, that would have been a career-ending catastrophe. For Kris Jenner, it was an accelerant. The show launched into a media environment already buzzing with Kim's name. Audiences were curious. E! was hungry, and the Kardashians delivered exactly what cable television needed. A loud, glamorous, emotionally raw family that never seemed to stop generating drama. Over 20 seasons and 14 years on air, the show reportedly earned the family over $100 million in total network fees. But the show itself was never the real business. It was the engine that powered everything else. Here is what Kris Jenner built that nobody talks about enough. She didn't just manage her family. She engineered a system. At the center of that system is a reported 10% management commission she takes from her children's business ventures. 10% of everything. Every brand deal, every product launch, every licensing agreement. She discussed this structure openly on Keeping Up with the Kardashians and in interviews over the years. Critics called it exploitative, but in business terms, it's a classic talent management model applied with ruthless efficiency. Kris became what the industry would eventually start calling a momager, a word that undersells what she actually is. She is a deal maker who understood before most executives did that a loyal audience is a customer base, and that a customer base, properly monetized, is worth more than any single television contract. Each daughter became a separate revenue vertical, and Kris sat at the top of all of them. The daughters didn't just ride the wave, they built their own. Khloe Kardashian co-founded Good American Denim with Emma Greda in 2016, a brand that publicly committed to inclusive sizing from day one. On launch day, it reportedly generated $1 million in sales. One day, Kourtney Kardashian launched Lemmy, a wellness supplement brand, in 2022, landing distribution at Ulta Beauty. Kim launched KKW Beauty in 2017, sold a 20% stake to Coty in 2020 for $200 million, valuing the brand at $1 billion. She later rebranded it as SKKN by Kim in 2022. And then there was Kylie. Kylie Cosmetics, built almost entirely on Instagram engagement and a single lip kit, became the story the entire business media couldn't stop covering. Forbes put Kylie on its cover in 2019 and declared her the world's youngest self-made billionaire. The internet exploded. And then the whole thing unraveled. In November of 2019, Coty Inc., one of the largest beauty conglomerates in the world, paid approximately $600 million for a 51% stake in Kylie Cosmetics. That deal valued the brand at roughly $1.2 billion. It appeared to be a complete validation of everything Forbes had been saying. Kylie wasn't just famous. She had built something a Fortune 500 company was willing to bet $500 million on. But then, something strange happened. Within 2 years, Coty began writing down the value of that acquisition in its earnings filings. The brand that had been worth over $1 billion on paper was publicly being revalued downward by the very company that had bought it. Investors and analysts started asking uncomfortable questions. Had the original valuation been inflated? Were the revenue and profit figures that made Kylie look like a billionaire actually as solid as they appeared? Those questions had a very direct answer coming. And it came from Forbes itself. In May of 2020, Forbes published one of the most dramatic retractions in its modern history. The magazine, which had famously crowned Kylie Jenner a self-made billionaire just 1 year earlier, now alleged that Kylie's team had misrepresented revenue figures and profit margins to the publication. Forbes alleged that tax documents and financial records provided to justify the billionaire valuation had been fabricated or significantly inflated. Kylie denied the allegations, but Forbes pulled the billionaire title anyway. The story ricocheted across every business publication in the world. Here was a 22-year-old who had built her entire personal brand around the idea that she had turned her social media following into a billion-dollar business. And the world's most recognizable business magazine was now saying the numbers didn't add up. It was the single most cinematic moment in the entire Kardashian business saga, and it forced a question that the whole family's empire rests on. How much of this is real business, and how much of it is the perception of business? That question is worth sitting with. Because the Coty write-down and the Forbes retraction didn't happen in a vacuum. They happened at the same moment the broader cultural conversation about the Kardashians was shifting. Keeping up with the Kardashians was winding down. Social media audiences were starting to question the authenticity of influencer culture. And suddenly the family that had been synonymous with aspirational wealth was being scrutinized in ways it hadn't been before. But here is what makes this family genuinely interesting from a business perspective. They didn't collapse. They adapted. Kim Kardashian, the person most exposed to public ridicule throughout the family's entire history, had already been quietly building something that had nothing to do with beauty products or Instagram followers. She had been building SKIMS. SKIMS launched in 2019 in the shapewear category, and the early investor response was not warm. Shapewear was considered a declining, commoditized market. Multiple investors reportedly passed on the opportunity. Kim pushed forward anyway. Within 4 years, SKIMS had expanded beyond shapewear into loungewear, swimwear, and men's underwear, landing a partnership with Team USA as the official underwear brand for the 2024 Paris Olympics. In January of 2023, Bloomberg reported that a new funding round valued SKIMS at $4 billion, putting Kim's personal stake at approximately $1.4 billion. The brand that investors said had no future was filing toward a potential initial public offering. It is one of the cleanest narrative reversals in recent startup history. Rejected, doubted, $4 billion. Kim did not stop there. In September of 2022, Bloomberg reported that she had co-founded SKKI Partners, a private equity firm targeting consumer and media brands. Alongside Jay Sammons, a former partner at the Carlyle Group, one of the most prestigious private equity firms in the world. This was not a celebrity vanity project with a borrowed name. Jay Sammons spent years at Carlyle executing deals in the consumer sector. Kim was positioning herself not just as a brand owner, but as a capital allocator. Meanwhile, the family negotiated a deal with Hulu reported to be worth over $100 million for the Kardashian series, which premiered in April of 2022. The television engine that Kris built with a cold call in 2007 was still running, just on a new platform, with new economics, and a family that now understood exactly what their attention was worth. So what does the full picture actually look like? You have a family that converted a reality television show into a brand licensing platform. You have a matriarch who structured herself as a 10% stakeholder in every vertical her children built. You have individual brands spanning shapewear, beauty, denim, wellness supplements, and private equity. You have real write-downs and a public fraud allegation that forced the whole machine to reckon with the difference between perceived value and audited value. And you have a comeback built on actual product revenue, legitimate institutional investors, and an Olympic partnership. The Kardashians did not build a business empire because they were lucky. They built it because they understood one thing earlier than almost anyone else in the social media era. Attention is an asset. If you can hold it long enough and convert it consistently enough, it becomes equity. That is not a reality TV strategy. That is a business model. This is the Founder Files, beyond the brand. If this episode made you see the Kardashians differently, even a little bit, that is the entire point. Drop a comment below and tell us what you think. Did Kim Kardashian build a legitimate business empire, or is this all still built on perception? We genuinely want to know where you stand. If you have not subscribed yet, hit the button now, because next week we are going inside one of the most audacious personal pivots in Silicon Valley history. A man who was told his company was worthless, walked away with nothing, came back a decade later, and turned that same company into a $150 billion juggernaut. See you next week on the Founder Files.